Today, I'm going to be walking you through how to analyze an investment property specific to rental properties. And we've been doing it for over 10 years. So, going to walk you through step by step how we would take a look at something. So, I have the MLS pulled up here as a real estate broker or agent. You're going to have access to the MLS or, you find a deal somewhere, right? So, we're just going to simply look for a income producing property. And I'm just going to focus on just a standard property, not a short sale or anything. So, you're looking at your live MLS stuff here. Just going to look for a duplex. Found one earlier in Tampa that I thought would be a good one to run a scenario on. We pretty much manage anywhere within an hour of Tampa International Airport. Born and raised in the area, know it really well. So walk you through some of the specifics. So this one's not super far from our office in Ybor. So just taking a look at it, they have it listed for 275,000. They're sort of proposing that expected rent could be 18 and 1,200 on 3 bedroom and 1 bedroom. So I'm going to be using bigger pockets for the report itself. And so we'll walk you through how we're going to go ahead and enter in some of the information to see if this is an actual deal. So they're asking 275,000. Most of the time, there should be at least some negotiation room there. We are going to put that we're going to be rehabbing this property. If you take a look at the photos, you're always going to mostly, unless it's super turnkey, you're always going to have something that you're going to want to do on the way in. Just a simple example is like, even if this was fully renovated, you got some trees that you're going to want to trim from like a hurricane standpoint anyways, right? So there's always going to be something that you're probably going to want to do. Obviously, coming into a property, rental properties, a lot of times you're going to look for how can I increase the rents if possible in the current marketplace. What repairs can I do to spruce up the property, right? So probably got some tree trimming. There's landscaping basically is non-existent. Got some stuff we need to probably seal up to prevent rodents getting into the property under the crawl space. Obviously, could use a painting. So you can tell from the photos here, this basically is a full rehab. You might be able to salvage some of the stuff in here, but pretty much we're just going to assume that we're basically going to do everything cosmetically. We might be able to leave some of the cabinets. We might add some lower cabinets, probably some fresh appliances and stuff like that. So quite a bit to do here from that standpoint. So we are going to rehab it, and we're going to put about 3% for closing costs. So as a buyer, you could always negotiate, hey, seller's going to pay some sort of closing cost, but we're just going to assume, I think I analyzed it earlier, 3% is about 8,250. We're not going to break it down itemized. Doesn't really matter for this report. We've invested in the area for a long time. So we kind of know we're just going to pencil in, hey, maybe this thing's going to be worth 400 grand when we're finished. It could be a mixture of rental values. It's going to depend on what that value might be. Obviously, I have not run sales comps in the area to see what other duplexes with similar incomes would generate for sales value. But assuming it's 3 grand a month, that's how we could back into that. So we're just going to say for now that it's probably going to be 400 grand is might be what we can do. And I'm not going to itemize, but this does give you a full breakdown. And I'm just doing the free trial on Bigger Pockets. I'm not paying for it, but it is a paid thing after 7 days. Repair costs. I'm just going to use a back of the napkin sort of idea. The Flipping Blueprint is a great book out there. It gives you some price per square foot that you might be able to use. Of course, you're going to have to look at that from your local market. I'm just going to ballpark that the property here on the MLS is listed at 2,100 square feet, heated square feet, 2,110. So we're just going to ballpark, all right, and it's going to need $25 a square foot. There's a lot of variables here, right? I'm just broad stroking. So we're going to look at the roof, roof on 2,000 square feet, I don't know, maybe it's 15 grand. We don't know right now if it's central or window units. Factor some of that in. We don't know if the electrical is updated. We don't know if there's aluminum wiring throughout. So it looks like mostly it's probably central AC. So we're just going to do $25 a square foot. But if I was trying to analyze this mentally, 15 grand for the roof, put another 6 for the AC. Maybe you have some electrical stuff that we got to fix. Maybe we have some, 1,000 plus 6 plus some electrical stuff that we're going to fix. Assuming there's some electrical stuff, maybe there's some plumbing stuff that we got to fix. 24 grand, and all you've really touched is the 4 points, right? We haven't even talked about flooring, cabinets, and stuff. So it's probably more than that. It's probably going to be more than that 50, because you have kitchens, flooring based on price per square foot just for flooring alone. You could be looking at I'm even on the low side, $3 a square foot. So now you're 6 plus the 24 we had. Sorry, this is gonna be like 30K, and we haven't even touched cabinets and stuff like that. So plus blinds, et cetera, landscaping, that sort of thing. So we're just gonna assume that could be low, but we'll just call it 52.5 for the repair costs on the front side. We're just gonna assume that somebody's gonna use leverage with like 25% down, interest rate. Haven't looked at the market, but let's just say for an investor loan or something, it's 7%. Assuming you're not going to live in one of the units and rent it out to the other, we're just going to buy this and rent out both. And maybe there's 3 points being charged on the loan. Gross monthly income. This investor or agent is saying that we can get maybe $3,000 a month, which you obviously want to always verify. The agent can always look at some numbers too, but you always want to get a property manager's opinion on what's actually happening in the marketplace. And then you can break it down by income. A duplex like this, you're probably not going to have any extra sort of income on the property. You would want to look at if it's one water meter. So if it's separately metered, the tenants can put the water in their own name, which is the best case scenario because you're not on the hook for water leaks or any of that stuff. Very common with the duplex that you have one water meter. So you typically would build in some sort of just flat monthly charge is probably the easiest way to do it. Or hey, for a 2-bedroom, maybe it's $50 a month or $75 a month. Let's just assume it's one water meter, and that the residents are going to reimburse us a total like $150 a month for that. That could be 150 times 12. Well, we could just do this, make it easy. Total monthly income is going to be 3150. All right, we'll just do that. We'll sort of assume it's going to be in there. And expenses, property taxes, just on the MLS, or you can use public records, Hillsborough County Property Appraiser, type in the address and find the tax records. The total tax for 2024, of course, this could get reassessed. You buy it, you improve it, values could change. So we're just going to assume, we'll just pencil in $2,500 for the property taxes on an annual basis. Insurance, just based off experience, I don't know, we'll call it maybe $2,500. Repairs and maintenance is different with capital expenditures. So going in and renovating the 50K, that would be more of a capital expenditure bucket. That's kind of like you're doing all these initial improvements. Roofs, some of those bigger ticket items are looked at as capital expenditure versus like if a tenant's living there and it's more routine maintenance, hey, the toilet's running, window got broken, something like that. So we're just going to pencil in 10% for the maintenance. I'm not going to put anything in capital expenditures because we already answered it above. Vacancy, the property's going to go vacant at some point. Could be in 1 year, could be in 5 years. 5% should always be the lowest, in my opinion. If more conservative you are, you could bump this up. Even if you're self-managing, whatever, just throw in 10%. We only manage for 8% a month. But again, if you have to sort of not have a management fee, or you have to sort of decrease the vacancy or repairs to 8% to make the deal work, it's not a deal. So you can tell right off the top, just between repairs, vacancy, and management, we're taking 25% of the income just off the top. Probably should be more. If you really want to be conservative, put 10% on the vacancy. If you are buying in an area that could be more transitioning, lower income, possibly like Ybor, Tampa Heights, that whole area it could be really just depends, right? So if you're a little more concerned about tenant quality and that you might have evictions over time, you might just buffer that up a little bit. And no HOA, garbage, water, sewer. Usually that's kind of including the water bill. I'm just gonna leave that stuff for blank for now. And we'll just assume, we're not going to just put any of that stuff in there. So finish analysis. So 3-bedroom, 1 bath, 1-1. So obviously you're wanting to verify that you can get that. That does sound somewhat reasonable for the area. Probably could be, yeah. Assuming we do a nice little update, probably is within range. 18 might be a little bit much for 3-1, but we're just going to sort of roll with it. And it's on public sewer. So yeah, don't know if it says it here about 1 water meter, but see what this generates for us in cash flow. So it's sort of giving us a $500 a month cash flow, expenses, cash on cash return. Cash on cash return is basically like how efficient your money is. So what's the return on money so if you're using a loan, if you're paying cash, it doesn't apply. If you're using a loan on the 25% that you put down, what's your return on just that 25% down payment? Would be 5%. But it's like, if you get 4 or 5% at the bank, is it really worth doing the deal? Yes, you might have additional tax benefits of owning real estate. you also have the risk. Tenant doesn't pay the rent, you have to go through evictions. So typically you would want more than what you could just get, the stock market or somewhere else. The tax benefits and that sort of stuff is usually should be looked at as like a bonus. Obviously, you don't want to do a deal that loses money every month for the tax benefits, right? So, uh, annualized return, mortgage payment, rental income, you can sort of play with all this stuff, but it's going to give us a breakdown of a few things here. So you have your mortgage, taxes, insurance, total expenses, 2576, variable expenses, vacancy, maintenance, whatever, right? So net operating income, cash on cash, pro forma cap rate's only 6%. It's hard to say depending on, if property was in a really nice area, you could have a low cap rate. Uh, for me, like based on this area and stuff, like you're going to want this to be 6, 7, 7, 8, 9% or something like that. It just depends, right? And the market rents are softening, right? So if rents continued to decline or you had trouble renting this, your cash flow went from maybe $500 a month to almost nothing. And so any larger maintenance expense pops up, you're basically in the red. So just depends on how much you would put down, how much the rent may grow over time. But but yeah, not like a huge spread there. But you can sort of see over time you make some basic assumptions, on average, a couple percent a year maybe on sales growth. And but rent growth, I wouldn't always pencil in a rent growth right now. We're having some softness in the market. So penciling, if you're underwriting this, you don't want to go in with, hey, 3% appreciation every year plus 3% on the rent growth. Like that's just not realistic. Um, so yeah, at the end of the day, $600 a month is definitely not terrible. If someone was going to live in this, it could be. But like I said, I think that the renovation budget, just we don't know what's at the property, right? So I like to always be conservative, assume that maybe it's going to take 30 to 60 days to find a resident. Um, and for me, I would want a better return than this, or just right, like maybe there's price negotiations that you could do. I'm not a huge fan of putting down more down payment to make the numbers work. So I think if the numbers don't work at like the minimum 20-25% down, I'm not a huge fan of trying to, you're really just fudging the numbers in my opinion. Unless that's your strategy of you want to have less risk by putting more down and you have less leverage out there in the marketplace. Like I totally get that. But to like put more down just to make the numbers work, not a fan of that sort of thing. So that's something that you guys can use. Bigger Pockets, take a look at it. So obviously would hope to get some negotiations on the price a little bit. I do think that the rental values can make sense. Obviously somebody's paying cash. That's something to consider, not a maybe terrible return if you're getting basically 36K a year and you could pick this up for like 250K or something like that. But taxes, insurance are continuing to, generally go up over time. So if you bought this and you're cash flowing $500 first year or whatever, and taxes and insurance increase the next year, like you could be basically breaking even without, any other, and then if you have rent decline, right? So I'd like to have a little bit more buffer. Because, if rents are stagnant or softening, but some of those costs that you can't control, like taxes and insurance continue to go up, then you're basically almost at a break even, which, generally isn't going to make sense, right? Like there could be some long-term benefits. You're going to hold it for 5 or 10 years or longer. The tax benefits, if you come in here and do all those improvements and you could do a cost segregation report, you really could have significant tax benefits. But again, you still want the deal to make money every month or achieve the goal that you're looking for the risk and the reward of the capital that you're putting in there. Like the money that you're putting down on this, would that be better spent maybe in the stock market? Who knows? We're always big proponents, obviously, of real estate, but there could be opportunities where you could just lend that capital out to another investor for 6 to 12 months and make 10% with no risk of, well, there's risk there, but no risk of tenant not paying. It's more of you become the bank, right? So you just have to evaluate the opportunity cost of the capital that you're putting into the deals, making sure you're underwriting them correctly and getting the rent prices realistic for the area. How long is it actually going to take to fill something? So, but this definitely could be a great property for someone that's going to live in one side, rent out the other. It could be a slam dunk because then you could use a FHA loan or put 3.5% down, first time home buyer kind of thing, and get into the property. That would be this would be potentially a pretty good deal for that. But a lot to analyze. Some of these older properties too. We don't know how the subfloors are if you walk through and it's really unstable. Um, you could really get high on a renovation cost in some place like this for some of the unknowns that we can't see without doing a formal inspection. And windows, there might be some windows that you need. So, it could easily reach a 75 or 100 grand renovation that you end up needing to do here. So, depends. Overall, a lot of great things happening in this specific area around Channelside, downtown, Water Street, Tampa Heights, a lot of development and stuff. So, bullish on the area long term for sure. So just want to walk you guys through on how we might take a look at the sort of analysis of something that we're looking at today. And yeah, the next step you could also factor in, hey, if we did this as a short term rental, what might that look like? Or if we were able, this property looks like a big square footage. So another strategy could be going in and actually adding some extra bedrooms and bathrooms. That's not something that we looked at here, but if you could make it, a 3-2 and a 1-1 or a 2-1 and a 3-2, then you're forcing appreciation. You're forcing the value through that, more bedrooms, more bathrooms. So there could be some opportunity here. If you walk the property, there might be a way to increase the value that somebody else is missing. Definitely a deal that somebody could look a little bit deeper into and see if it actually makes sense. So hopefully that was helpful. And if there's any other follow up questions on analysis or anything, feel free to reach out to us. And thanks for watching.